unemployed, and inflation was well below our 1 to 3% inflation target range. Uncertainty was extremely high. Vaccines were being developed, but nobody knew when they'd be available or even if they'd be effective. Beaucoup de choses sont passées depuis. Il y a eu deux autres vagues de virus, ce qui a retardé la reprise. Mais grâce à la résilience des ménages et des entreprises du pays et les mesures budgétaires et monétaires exceptionnelles, l'économie a continué à croître. La croissance a été volatile et très inégale. Tout le monde a été confronté à beaucoup d'incertitudes, mais l'économie a été remarquablement résiliente. Et maintenant, on a accès à des vaccins très efficaces. Les cas ont diminué, la vaccination progresse bien et les mesures sanitaires sont assouplies. C'est pourquoi le conseil de direction s'attend à un fort rebond à la réouverture de l'économie. Nous croyons que cette fois, la croissance sera plus durable. My second message is that the unique characteristics of the pandemic have continue to evolve, and there is continued need for careful attention to the dynamics of the recovery and to inflation. Globally, the economic outlook remains highly dependent on the virus, and these new variants are a growing source of concern. In Canada, we still have some way to go to a complete recovery, and the rebound in economic activity will proceed at different speeds across different sectors. The process of reopening the economy, it's not going to be entirely smooth. For example, we're experiencing supply bottlenecks for some goods and services as demand rebounds faster than supply can ramp back up. These unique circumstances of the pandemic are now helping to push inflation temporarily above our target range. As we reopen the economy, we can expect to see some volatility. And my message to you is that we will continue to pay close attention to the progress in the recovery and to the evolution of inflation. Before I turn to your questions, let me say a few words about the Governing Council's policy discussions. We spent some time considering the progress of and the risks to the global economic recovery. The global economy is recovering strongly, but vaccination rates and growth are uneven across advanced and emerging market economies. Growth is particularly strong in the United States, which is further ahead in the reopening and is benefiting from considerable fiscal stimulus. Oil prices have moved higher with stronger global demand, while other commodity prices have remained elevated. The Canadian dollar is close to where it was in April relative to the US dollar and slightly stronger against a broader basket of currencies. Coming back to Canada, we discussed the many ways in which the pandemic is affecting our economy and the prospects for recovery. There was a strong consensus that growth will strengthen and broaden in the months ahead as consumers return to more normal spending patterns, higher foreign demand lifts our exports, and investment increases. Consumption is expected to lead the recovery. Some of the sectors hit by the lockdowns, including retail, restaurant, and other hard-to-distance sectors, are already seeing a rebound, and others, like business and international travel, they may take a little bit longer to recover. Employment should continue to rebound over the next few months as the reopening process continues. The job gains we saw in June are certainly encouraging, particularly for workers in the service sectors that have really borne the brunt of the job losses. But to get back to the pre-pandemic employment rate, we still have more than 500,000 jobs to recoup. Our Business Outlook survey showed that plans to hire staff are widespread as firms prepare for rising demand, but finding workers with the right skills can be difficult, and that process could take some time. Si on compare les perspectives actuelles à notre prévision d'avril, on voit que la croissance au premier semestre est un peu plus faible qu'on le pensait. Ça reflète des problèmes liés aux chaînes d'approvisionnement et le prolongement des mesures sanitaires dans certaines parties du pays. On prévoit un fort rebond durant la deuxième moitié de l'année et une croissance plus soutenue en 2022 que dans notre projection précédente. La Banque s'attend maintenant à une croissance d'environ 6 en 2021. Elle a revu à la hausse sa projection pour 2022, soit 4,5 et anticipe une croissance de 3 et quart en 2023. Le Conseil de direction a aussi discuté le marge des capacités excédentaires dans l'économie et des perspectives pour la croissance du potentiel. Les estimations de ces mesures ont toujours été imprécises, mais elles sont encore plus difficiles à établir en raison des changements rapides causés par la pandémie. Dans la projection, les capacités excédentaires sont absorbées au deuxième semestre de 2022. Pour mieux gérer l'incertitude à cette évaluation, on surveille un grand nombre d'indicateurs comme les mesures des conditions sur le marché du travail. The outlook for inflation reflects the dynamics of overall demand and supply in the economy, as well as a number of temporary factors. In recent months, the consumer price inflation, the CPI, has risen above the bank's 1 to 3% target range. And there are three major factors behind the temporary strength, and they're all related to the pandemic. First, gasoline prices rebounded from very low levels a year ago and are now above pre-pandemic levels. Second, some other prices that had fallen sharply when demand was plummeting a year ago are now recovering to more normal levels as we reopen the economy. And third, disrupted global supply chains and pandemic-related supply constraints, including shipping bottlenecks and global shortages in semiconductors, have pushed up the prices for cars and some other goods. What we're seeing is that supply bottlenecks are creating sharp movements in prices that's pushing inflation temporarily higher, and these supply issues now look to be more important than we previously thought. As a result, inflation is now projected to be somewhat above the target band through 2021. But these temporary effects are forecast to dissipate near the end of this year, and inflation is forecast to ease back towards 2% in 2022. We expect the factors pushing up inflation to be temporary, but their persistence and magnitude are uncertain, and we will be watching them very closely. Longer term, given our commitment to hold the policy rate at the effective lower bound until slack is absorbed, the economy is projected to move into modest excess demand, so inflation is slightly above target through 2023 before moving toward target in 2024. In sum, reopening the economy and the strong progress on vaccinations has given us reason to be more optimistic about the direction of the economy. But we're not there yet, and we are mindful the process is likely to be bumpy, and some scars will remain. At today's decision, the Governing Council judged that the recovery still needs extraordinary support from monetary policy. We remain committed to holding the policy rate at the effective lower bound until slack is absorbed, so that the 2% inflation target is sustainably achieved. Based on our current projection, that happens sometime in the second half of 2022. Our quantitative easing program continues to reinforce this commitment. We decided to adjust the program to a target of $2 billion of weekly purchases of Government of Canada bonds, which is down from a target of $3 billion a week. This adjustment reflects continued progress towards recovery and the bank's increased confidence in the strength of the Canadian economic outlook. Les décisions au sujet de tout autre ajustement du rythme des achats net obligations seront guidées par l'évaluation et contenu que fait le Conseil de direction de la robustesse et de la durabilité de la reprise. Si l'économie évolue en gros selon nos projections, on pourrait réduire les détentes au fil du temps. Les autres révisions de notre programme d'assouplissement quantitatif continueront d'être graduelles et nos évaluations des nouvelles données et la communication de nos analyses seront bien réfléchies. Decisions regarding further adjustments to the pace of net bond purchases will be guided by the Governing Council's ongoing assessment of the strength and durability of the recovery. If the economy evolves broadly in line with the outlook, then over time, we won't need as much QE. Further adjustments to our QE program will continue to be gradual, and we will be deliberate both in our assessment of incoming data and in the communication of our analysis. We will continue to provide the appropriate degree of monetary policy stimulus to support recovery and achieve the inflation target. And with that, I'd be very pleased to take your questions.
Thank you, Governor. And we will go to questions now. We're going to try to do one question per reporter in this first round with a quick follow-up, and I'll ask you to state your name and affiliation. I just want to remind people to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again. Avant de poser une question, veuillez vous identifier et libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6. Pour l'enlever, faites étoile 6 encore une fois. So we'll get started with Julie Gordon from Reuters, followed by Greg Bonnell from BNN Bloomberg, and Mark Rendell of the Globe and Mail. So Julie, I'll turn to you for the first question.
Hi there, Governor. Thank you so much for taking our questions again today. You had to adjust your inflation outlook because it has been more sustained than expected. What is it makes you forecast that it is still going to be transitory?
Well, good morning, Julie. Look, there are three sets of factors or reasons why we believe that this rise in inflation will be temporary. First of all, when you look at what's actually driving inflation higher, these look like temporary factors. Secondly, there's still a considerable amount of slack in the economy, and that will put downward pressure on inflation. It is putting downward pressure on inflation, and that's going to continue until the output gap is closed. And third, when we look at survey evidence, when we ask firms about their intentions, what we see is the evidence suggests that this isn't going to continue. So let me just unpack those for you in a little more detail. So as I said, the first factor is when we look at what's actually driving inflation higher, these things look temporary. There is a combination of factors. So keep in mind that the first point is that inflation a year ago was very low. It was about 0. And so as prices today are being compared to very low prices a year ago. So you take gasoline, for example, before the pandemic, it was about $1.30 a liter. Last year, it was down to 70 cents a liter, 70-something cents a liter. I filled up last week, it was $1.36. So, that $1.36 is getting compared to the very low prices a year ago, so that's a big boost to inflation. There are some other goods and services whose prices plummeted in the darkest days of the pandemic, a little over a year ago. And as those prices normalize, again, you're getting some large year-over-year increases. But really, these prices are basically normalizing to where they were before the pandemic. We call this base year effects. The third factor is, and this is what is really getting more emphasis in this report. This is what is newer, is there are a number of supply bottlenecks. A couple of examples. Global shipping prices have gone up, and that really reflects the fact that because we can't buy a lot of services we want to buy, we're substituting into goods. You can't go to your local gym, so maybe you bought an exercise bike or a treadmill. Those goods all have to get shipped. There's a lot of demand for shipping of goods. Prices of shipping have gone up as shipping adds capacity, and that's temporarily boosting. That's boosting the prices, which is temporarily boosting inflation. Semiconductors, there are disruptions in the global supply chain for semiconductors. That's showing up in car prices, for example. remind you that, inflation is ongoing increases in prices. What we're seeing are some sharp movements in prices, but that doesn't look like inflation. It's unlikely to cause ongoing price increases. So these effects on inflation should be temporary. So that's the first set of factors. The second is there's a lot of excess supply in this economy. There are still many Canadians out of work. You look at some numbers, we estimate the output gap is between -2 or 3%. Unemployment's 7.8%. That's about 2 percentage points above the pre-pandemic level. Total hours worked still 4%, more than 4% below pre-pandemic levels. We're still, as I mentioned in my opening statement, to get back to the same employment rate, we still need to recoup more than 500,000 jobs. So no matter how you look at it, there's still a considerable amount of slack in the economy. That's putting downward pressure on inflation. So as those temporary factors wane, inflation will come down. And then finally is a range of survey evidence. If you look at surveys of inflation expectations, if you look at implied inflation expectations in the term structure, they have longer run inflation expectations have really not moved at all. People are not expecting this to be durably higher inflation. And when we asked firms, in our Business Outlook survey, we went and we asked firms, what are your plans? And 60% indicated that they expected the pace of price increases this year to be similar or lower than pre-pandemic. 15% said they would be higher, and that does reflect that we are definitely seeing some price pressures in some specific areas, but it's not broad-based. So look, let me just sort of summarize a long answer, but it's an important question. Of course, there's some uncertainty here. We don't have a crystal ball. We expect these effects to dissipate later in the year. And if you look at our forecast, inflation comes down to 2%, sort of second half of next year. But sure, there's some uncertainty about this. We will be watching these effects. We will be watching the evolution of inflation very carefully.
Okay, thank you for that. And as a follow-up, has the housing market frenzy passed its peak, or do you foresee some price escalation again later this year?
Well, if you look at our outlook in the monetary policy report for housing, we've already seen some moderation in housing activity. The levels remain quite elevated, but we've seen some moderation. We do expect to see continued gradual moderation. In the last part of the report, in the risks, we indicate, look, there are some risks around that. That moderation could be faster than we expected, than we've projected. There's no question that an important reason, one of the unusual circumstances of the pandemic is that everybody's been at home and people are working at home, their recreation is at home, their children are studying at home, their meals are all at home. Understandably, they've wanted more space, and that's boosted demand for housing. We'll have to see. Once we can all go, now that we can go back to a restaurant, do you still want a bigger kitchen? We'll see. So that's hard to gauge. It could come back faster. On the other hand, we've got a relatively strong growth forecast. We expect Canadians will be getting back to work. They will be feeling more confident about their incomes. We expect immigration rates to ramp back up. That's important to growing the potential of our economy. So, there are also some other reasons why it could be stronger. I think what we've put in our report, I think, provides a balanced view.
Okay, we'll go now to Greg Bunnell from BNN Bloomberg, followed by Mark Rendell of The Globe. Greg.
Yes, Governor. Thanks for taking my question. I want to talk about the recovery in the sense that it's highly logical to think that the consumer will lead this recovery, and then at some point you're hoping it strengthens beyond that. I see exports mentioned. What I was going to be talking about, I had to stop back several years to your predecessor, Stephen Poloz, waiting for the consumer who had carried the economy on their back coming out of the financial crisis to sort of give way to the exports, and it sort of didn't come. I mean, what's the risk here as we try to hand off growth from one area to another, that we get stuck just relying on the consumer for a very long time, just like we did at the financial crisis, and we know the carrot there is cheap money. How long do we get stuck in this idea that we need to keep providing cheap money to the consumer to carry this economy?
Well, Greg, As I've indicated, we do expect this to be a consumer-led recovery. And one of the things that has struck us through this pandemic is just how resilient the consumer has been. That has a lot to do with exceptional fiscal support and monetary policy stimulus. And as Canadians, we've already, we had something like more than 3 million Canadians at the worst. We're now back to it's about 350,000 jobs to go to get back to pre-pandemic level, or about half a million to get back to the same employment rate. So we still have some way to go, but we've come a long way back. And with those incomes, we expect to see consumer spending. Frankly, we expect to see Canadians getting back to more normal spending patterns as the economy reopens, and increasingly they're getting back to work. On the export side, the U.S., our U.S. economy is strong. Our U.S. outlook is strong. U.S. is by far our biggest destination for exports. It's clear that the U.S. economy is experiencing some capacity constraints. So we do expect that the demand for our exports will be lifted by that strong U.S. economy. And when you've got good consumption growth and good export growth, that's when firms start to invest more. Firms become more confident that the demand will be there, and they really start investing and adding capacity. When we look at our own business outlook survey, we do see business investment intentions have strengthened. And going forward, we expect to see business confidence firm further, and we do expect to see this broadening from consumption to exports to investment. Are there some risks around that? Sure, there's some risks around that. Coming back to exports, if the Canadian dollar, in our projection, we assume the Canadian dollar remains about where it is, around 80 cents. If the Canadian dollar were to move higher, that would put additional competitive pressure on our exporters. It would make imports more attractive. That could certainly take something off our projection, and that's something we'd have to take into account.
As a quick follow-up, I just want to ask you mentioned obviously how key the labor market recovery is to this. We talked to a lot of business leaders on BNN Bloomberg, of course, and they're telling us it's pretty hard to find workers, that it's competitive. That suggests, of course, that you have to pay people more money to win them over to come join your organization, and that feeds into inflation. So how could all that sort of spiral into a way that you get an inflation that is not transitory, because workers usually don't like to give back their raises?
Well, look, as I mentioned, I think one of the things we are learning more about is it's a lot easier to close the economy than it is to reopen one. And particularly in some sectors, demand can rebound faster than supply can keep up. I mean, you think about a restaurant. Normally if your restaurant's operating and you want to expand, so maybe you need to hire a few more workers. Most restaurants now have been virtually closed or operating with really skeletal staff. They've got a lot of people to hire. That's going to take some time. And that's part of this complicated process of reopening the economy. And yes, we are hearing through our own business outlook survey that some companies are having trouble finding the workers they need. They're having trouble finding the skills they need. They need to invest in training. That's going to take some time. But these are sort of temporary adjustment issues as you reopen the economy. And one of the things we have seen repeatedly through this crisis is there's a lot of ingenuity on the part of companies to figure out how to cut through these supply issues. So we've seen a series of supply issues go up and then get resolved. And that's what we're expecting to continue. I mean, coming back to wages, to this point, wages are really quite subdued. If we did see wage growth running well ahead of productivity, that would be a sign of concern. That would be a sign of increased risk of more broad-based inflation. So far, we're not seeing that.
Thank you, Governor. We're going to move now to Mark Rendell from the Globe and Mail, followed by Greg Quinn from Market News.
Hi there, can you hear me?
Yes, Mark.
Great. Thank you so much for taking the question. Wondering about the medium-term inflation outlook. It looks like, and as you addressed with your earlier question, that there are transitory things pushing inflation up now and over the next year or so. But it looks like in the projection, inflation dips down and then it raises back up, and it doesn't actually really settle until 2024. So once we're past the kind of transitory things that you mentioned in the earlier question, what is it that's keeping inflation elevated and leading to that secondary spike and that kind of trajectory towards back to target not happening until 2024?
Well, if you look at chart 18 of the monetary policy report, Mark, it breaks it down for you in more detail. But let me put it in words for you. So, building off the answers I've just given, we've got considerable amount of excess supply in the economy. As these temporary factors wane, the considerable amount of excess supply in the economy, that dominates. Inflation comes down in our forecast. So when you get to the second half of next year, inflation's around 2%. And then as you indicated, it then drifts up a bit in 2023. And that's really a consequence of our forward guidance. Forward guidance is an important part of our extended toolkit. And we've committed to hold our policy rate at the effective lower bound until slack is absorbed so that we sustainably achieve our inflation targets. So, in the projection, there's quite a bit of uncertainty about exactly when this will eventually happen. But in our projection, the output gap closes in the second half of next year. And because we're holding the policy rate at the effective lower bound until it closes, and there are some lags in monetary policy, you can expect to see some modest excess demand in 2023. The economy is expected to go into modest excess demand, and so that produces a modest increase in inflation above the target before we go back towards target in 2024. That's part of the flexibility that we have in our flexible inflation targeting framework. We have a band of 1 to 3, and given the truly exceptional circumstances of this pandemic and the huge size of this shock, we are using our extended tools, forward guidance, and quantitative easing, and that's really what you see reflected. I would just conclude by saying I think forward guidance has been a very effective tool in our extended toolkit, and it's working.
On the question of forward guidance, you reiterated what you said in April about not raising rates until the second half of 2022 at the earliest. And I'm wondering, with GDP growth now coming in lower for 2021, with expectations that potential output is going to be growing faster, how do we still keep the forward guidance, that same kind of second half of 2022 target the same, given the other factors that are changing?
Well, for 3 points here, Mark. First of all, our outlook is not really that different from the one we put out in April. Of course, we've received a lot of new information. There are some differences, but if you step back, the outlook is not that different from April, and the output gap in April closed in the second half, and it continues to close in the second half. If you look at sort of the next level of detail, as you just indicated, near term, really the first half of this year, which is already over, GDP growth has been a little bit weaker than we saw in April. Q1 came in slightly below what we were projecting, and Q2, we have revised down our expectations for Q2 slightly, and that really reflects that the containment restrictions related to the third wave in some parts of the country were a little bit longer than we expected, and the supply constraints that I've mentioned. So, they're affecting, for example, production of cars. They can't get enough semiconductors, so they're producing less cars. So Q2 has been a little bit weaker. So we're starting off slightly weaker, but the growth trajectory going forward is a bit stronger. And that really reflects the fact that we've seen rapid progress in vaccinations. We are more confident about the outlook. And even more importantly, Canadians and Canadian businesses are more confident. And that we think will be reflected in their spending and investment decisions. So we get a slightly stronger rebound. And if you look actually at chart 2A, I think it is in the monetary policy report, you can see this pretty clearly. So we start a little weaker, we have stronger growth. So by the end of the projection, actually, the level of GDP is actually slightly above. But you start weaker, you get stronger growth, it kind of evens out. And so that's why we're still second half of, output gap closes second half of 2022. I would underline, though, that there is a lot of uncertainty about exactly when the output gap ultimately will close. It's going to depend on the evolution of demand in the economy, but also the evolution of supply, which is particularly hard to assess given the unevenness and the very unique circumstances of this pandemic.
We'll turn now to Greg Quinn from Market News, followed by Paul Vieira of the Wall Street Journal. Greg.
Good morning. I would like to ask first about a bit about your views in general on what happens to the asset purchases from here as they're winding down. And for example, do you think it's necessary to completely end quantitative easing before you would raise interest rates?
Well, you're getting into future monetary policy decisions, so I'm looking forward to these questions at future press conferences. But I will provide some response. Well, first of all, let me underline that our QE program is continuing. We will continue to be buying at a pace of $2 billion a week, down from $3 billion. We don't. Because of the progress we've seen in the recovery, because of our increased confidence in the outlook, we don't need as much QE, but we continue to need quantitative stimulus, and QE is continuing to reinforce our forward guidance. As I said in the opening statement, looking forward, as the economy, or if the economy continues to evolve in line or stronger than our outlook, we won't need as much QE going forward. And so if that plays out, there will be future adjustments. And as we adjust QE down further, at some point we'll eventually reach a point where our gross purchases, will be roughly equal to the maturities. So in other words, the new bonds we're buying will be roughly equal to the bonds that are rolling off our balance sheet as they mature. When that happens, we'll be entering what we call the reinvestment phase. And in the reinvestment phase, I think you can expect we're still going to have a very big balance sheet. That's still going to be providing a lot of stimulus, but we won't be adding incremental QE stimulus. When we get to the reinvestment phase, how long we're in the reinvestment phase, those are monetary policy decisions, and that will depend on the incoming data and our assessment of the outlook and our assessment of how much stimulus we need to achieve our inflation target. The only other thing I can say is, when we do eventually get to this reinvestment phase, there are also some sort of operational balance sheet management issues, and So we will need to look at those, and we will certainly be very clear on those implementation issues when we get there. But we're not there yet. Right now, we continue to need our quantitative stimulus program, and it's working.
Thank you. Secondly, I wondered about the coordination of economic policy when the economy was hit with the pandemic. The government and the Bank of Canada did some coordination on putting in stimulus. With the confidence in the rebound we're seeing, do you expect to be talking to the government on the other side and taking some action to coordinate any removal of stimulus in the future?
Well, look, by legislation, I was going to say meet. We actually don't meet very often, but I do discuss economic developments with the Minister of Finance. We have the operational independence, we have a clear mandate, and we take decisions to pursue that mandate. Look, we're all working for the benefit of Canadians. We all want to see a good recovery. Certainly our job is to make sure that that good recovery comes with inflation that remains at 2%. And we're committed to achieve that, and we'll take whatever actions are needed to achieve that objective.
Okay, I've got 4 people left on my list and about roughly 10 minutes, so let's see how we do. Paul Vieira from the Wall Street Journal, followed by Shelley Hagan of Bloomberg. Paul, please go ahead.
Governor, you talked about looking at labor market indicators to judge the amount of slack. In the NPR, there's a lot of emphasis on the employment rate. Is that the key metric the Bank of Canada is going to be to judge whether slack in the labor market has dissipated or has been absorbed?
Yeah.
Can you expand?
Yes, I can expand. I guess my message here is I would discourage you from fixating on any one statistic. We really need to look at the overall health of the labor market. And just to give you, don't take this as a comprehensive list, but just to give you some, an indication of the kinds of things we will be looking at, obviously you're going to look at the unemployment rate. The employment rate has the advantage that, the unemployment rate, if people become discouraged about looking for work and drop out of the labor force, they're not counted as unemployed, because to be unemployed, you have to be actively searching for work. The employment rate actually looks at, how many people really are at work. That's why you want to look at both the unemployment and the employment rate. There are some other things, though. You'd want to look at full-time employment. What is the composition of employment? Full-time, part-time, self-employed, private sector, public sector. You want to look at different parts of the labor market. As we've talked about repeatedly, the effects have been very uneven. I mean, men employment is about 1.5% below pre-pandemic levels. Women still a little over 2%. Those gaps have narrowed as the economy is reopening. We expect them to continue to narrow. The labor utilization rate, that's a broader measure, includes people who would like a job but aren't actively working. It also factors in how many hours people are working. So right now, labor utilization is about labor underutilization is about 16%. Pre-pandemic, it was 11%. In the worst days of the pandemic, it was over a third of the labor market. So we've come a long way back. Another one, you want to look at hours. It's not just employment, but how many hours. So hours worked, total hours worked still about 4% below pre-pandemic levels. So, and that's not a comprehensive list. My message really is you really got to look at a broad range of labor market indicators and come to an overall assessment of the health of the labor market. And you've also got to look at productivity. You've got to look at investment. Those also contribute to how much capacity the economy has.
I'll skip my follow-up. Thanks.
Thank you, Paul. We'll turn now to Shelley Hagan from Bloomberg, followed by Jordan Press of the Canadian Press. Shelley, please go ahead.
Hi, Governor Macklem. Now that you're approaching the wrap-up of QE by adjusting the pace of purchases to $2 billion a week, can you give us an idea of how tapering looks like going forward? Would you ever kind of use the wording to target net purchases rather than gross purchases?
Well, I think I answered that question before. As I said, right now we need the QE we have. I've indicated that if the Canadian economy evolves broadly in line, or stronger than our projection, we're not going to need as much QE over time. And as indicated in the press release and in my statement, the Governing Council will be looking. In coming to that judgment, we'll be assessing the strength and the durability of the recovery. So those will be the key factors that will be weighing on future adjustments. And in the previous answer, I sort of gave an indication of eventually that would get you to this reinvestment phase.
Would you ever, I guess, be guided, though, on like kind of changing the language in your statement to like net purchases?
Well,
when you talk about how you're adjusting like the pace of purchases from your gross purchases to $2 billion, would you ever kind of?
Well, we talk about gross and net. There, gross is, so our gross purchases now are $2 billion a week. There are some maturities, so net is less than $2 billion a week. Right now, our maturities are relatively small. Going forward, as you roll forward, because we bought a lot over the last year and a half or year and 16 months, maturities will start to rise, and you can, that's all on our website. I mean, we disclose all our purchases. You can see when the maturities, so you can see how much will be rolling off.
Okay, we'll turn now to Jordan Press from Canadian Press. We'll wrap up after that with Tony Mace of Mace News. Jordan, please go ahead.
Good morning, Governor. My question is about the labor market as well. Can you just explain a little bit about how much scarring you expect in the labor market now that you've had a little more data to look at, and maybe just why the scarring may be either deeper or not as deep as you previously expected?
We are worried about scarring. If you look at measures of longer-term unemployment, they are very high. And what we've seen in previous deep recessions is that when people are unemployed for long periods of time, a few things happen. One is some people become discouraged. They stop looking for work. They drop out of the labor force. That reduces the overall capacity of our economy to grow. It's also pretty tough on those individuals. The other thing that when people are out of the labor force for a long time, they're losing opportunities for on-the-job training. They're losing learning opportunities, particularly for younger workers. That's really important. And so it can take, even when they do get a job, it can take them some time to get back up to, the income that they would have been making. So we do worry about scarring. As you suggested, I think the good news is that we are becoming more confident about a strong rebound. And if you look at the June employment numbers, you did see strong gains in youth employment, particularly for young women who have been hit the hardest. There's still it's still uneven. There's still catch up to be had here. But some of those hardest hit groups are benefiting quite a bit from this reopening, and we expect that to continue. That should bring down this longer-term employment rate, and so hopefully the consequences of scarring are minimized. I think the other element is that for some of these sectors that are coming back, the amount of training isn't as big as some other sectors. So again, the potential to catch up may be there. But this is something we're concerned about. We do think the scarring will be less than what we thought it might be 6 months ago, because we are more confident in that recovery. But it is a concern.
And I guess just as a very quick follow-up, given you're talking about a consumer-led recovery, I'm wondering, what is it that you've been doing maybe to add to that recovery? Maybe telling others, some of your friends and family, what they should be doing as well.
Well, I'm not sure I'm going to give too much personal advice. So what have I been doing? Well, I mentioned the example of well, if your gym's closed, maybe you buy a treadmill or an exercise bike. Well, I bought an exercise bike, and I will admit it's helped me get through this crisis.
Our final questioner will be Tony Mace of Mace News. Please go ahead.
Hi, Governor. Thanks for the opportunity. You mentioned, I believe, some concern about the Canadian dollar, and if it were to appreciate further, that it could affect Canadian exports. How would you characterize what you've been seeing in terms of the exchange rate? And what kind of a move would attract your attention or concern?
Yes, well, exchange rate's always a tricky topic. So, as I indicated in our projection, we've assumed an 80-cent dollar. And let me just begin by reminding you, we don't target the dollar. That's an assumption. We target inflation. We have a flexible exchange rate. That's an important part of our framework. And that's an important adjustment mechanism. So we've assumed an 80-cent dollar. And that is embedded in our projection. If the Canadian dollar were to be materially higher than that, I think we'd be asking ourselves, why is it materially higher? So if it's materially higher because of some good developments in Canada, that's the flexible exchange rate doing its work. So for example, if commodity prices were stronger, that's good for Canada. We are a big exporter of commodities. That means more income coming into the country. When the exchange rate appreciates, actually that spreads the benefit across the country because not just the commodity producers benefit from, but every Canadian who's buying imports benefits from it. On the other hand, if the Canadian dollar were to move for reasons higher, for reasons that are not related to some good developments in Canada. So for example, one thing we've seen over the last year, if we saw broad-based depreciation of the US dollar for US reasons that puts upward pressure on the Canadian dollar, that would be more of a source of concern in the sense that that would be negative for our exports. It would create more import competition for Canada, and that would dampen our outlook, and that's something we'd need to take into account. Let me stop there, and thank you very much.
Thank you.
Tony, if you do have a quick follow-up.
Oh, okay. Yes, please.
Quick.
In connection with the labor market indicators and the array of indicators you mentioned, will you be targeting things like the jobless rate for low-wage workers or others who may have been hit most by the pandemic?
No. We have one target, and that's inflation. We are looking at those things because in order to get inflation sustainably back to 2%, you need to close the output gap. You need to absorb that excess slack. If we have excess slack in the economy, that means we're missing jobs, we're missing income, we're missing spending, and that will put downward pressure on inflation, and we won't sustainably achieve our inflation target. So that's an important input to achieving our inflation target, but the target is inflation.
And that concludes today's press conference. Thanks to Governor Macklem. Thanks to everybody for joining us and for your questions. I'd like to wish everybody a nice, safe, and healthy and relaxing summer. And we'll see you all in the fall. Take care.
Thank you.
People. Myself from the traditional territory of many nations, including the Wendat, the Anishinaabe, the Haudenosaunee, the Métis, and the